Due diligence valuation reports explained. In this video, we will go over the importance of due diligence valuation and reports. When investors consider putting money into a company, they do not rely on presentations or pitch decks alone. Before making an investment, they conduct a process called due diligence. Due diligence is the process of verifying that a business is financially sound, legally compliant, and operationally capable of delivering the results it claims. A due diligence valuation report helps investors analyze a company in detail before committing capital. In this video, we will walk through what a due diligence valuation report contains and why each section is important. The report begins with a company overview and financial foundation. This section provides the basic context for the business. It includes information such as the industry, company stage, number of employees, and headquarters location. It also summarizes the company's key financial indicators. For example, a SaaS company may generate €1.5 million in annual recurring revenue, with monthly recurring revenue of €125,000. Growth rates, profit margins, and customer numbers are also included. These numbers help investors quickly understand the scale and momentum of the business. The report then examines unit economics and operating efficiency. Unit economics measure whether a company's business model is sustainable. For example, the report may analyze customer acquisition cost and customer lifetime value. Customer acquisition cost represents how much the company spends to acquire a new customer. Customer lifetime value represents the revenue expected from that customer over the duration of the relationship. When lifetime value is significantly higher than acquisition cost, the business model is usually considered healthy. Other metrics such as payback period, retention rates, and operating efficiency help investors determine whether growth is economically viable. Another key section is the 5-year financial projection model. Investors rarely invest based solely on current performance. They invest based on what the company could become in the future. Financial projections estimate how revenue, customers, and market share may grow over time. For example, a company generating €1.5 million in revenue today might project growth to more than €16 million over 5 years. While projections are never guaranteed, they provide a framework for estimating potential company value. The next section evaluates the management team and leadership. For early-stage companies especially, investors often say they invest in the team as much as the idea. The report reviews the experience, background, and expertise of the founding team and senior executives. For example, founders may have previous experience building software companies, working at major technology firms, or leading enterprise sales teams. A strong leadership team with relevant experience significantly increases investor confidence. After the team analysis, the report moves into market analysis and competitive positioning. Investors need to understand the size of the market opportunity. 3 key metrics are commonly used. Total addressable market represents the maximum possible market size. Serviceable addressable market represents the portion of the market that the company can realistically serve. Serviceable obtainable market represents the share the company believes it can capture in the near term. Market growth rates and competitor analysis also help investors determine whether the company operates in an expanding industry. Another critical part of the report is product traction and market validation. This section shows whether customers actually use and value the product. Metrics such as user activity, system reliability, customer retention, and Net Promoter Score help demonstrate product adoption. For software platforms, additional indicators such as API usage, data processing volume, and feature adoption rates may also be analyzed. Strong product traction suggests that the company has achieved product-market fit. Next, the report evaluates the company's go-to-market strategy. This section explains how the company plans to acquire customers and grow revenue. Some businesses rely on direct sales teams, while others grow through partnerships, online marketing, or distribution channels. Understanding the sales strategy helps investors determine whether the growth projections are realistic. One of the most important parts of any due diligence report is the risk assessment. Every company faces risks. These may include market competition, regulatory changes, financial pressure, or operational challenges. Due diligence reports identify these risks and evaluate how they could affect future performance. For example, a company may face risks related to customer concentration, dependence on key employees, or rapid changes in technology. By identifying these risks early, investors can better assess whether the potential return justifies the risk involved. Unlike a simple valuation report, a due diligence report also includes enhanced institutional analysis sections. These sections are designed for professional investors, venture capital firms, and strategic acquirers. They often include detailed financial verification, legal compliance checks, intellectual property analysis, operational risk assessments, and customer relationship reviews. These additional sections help investors verify the reliability of the information provided by the company. The report then applies multiple valuation methodologies to estimate the company's value. Professional valuations rarely rely on a single calculation. Instead, several approaches are used to evaluate value from different perspectives. For example, the discounted cash flow method estimates value based on projected future cash flows. Market multiples compare the company to similar businesses that have been sold or publicly traded. Early-stage companies may also use methods such as the venture capital method, scorecard method, or Berkus method. By combining several methodologies, the report produces a valuation range rather than a single number. This helps investors understand both the potential upside and the uncertainty involved. The due diligence report may also analyze exit scenarios and investment returns. Investors want to understand how they might eventually realize their investment. Possible exit paths may include an acquisition by a larger company, a public listing through an initial public offering, or a secondary sale to another investor. The report estimates potential returns under different scenarios to help investors evaluate whether the opportunity fits their investment strategy. Finally, the report includes an independent verification and methodology review. Professional due diligence reports often follow international valuation standards and recognized accounting frameworks. This ensures that the valuation methods, assumptions, and financial models are transparent and consistent with industry practices. The report also includes limitations and disclaimers, acknowledging that valuations depend on the accuracy of the underlying data. In summary, a due diligence valuation report provides investors with a comprehensive analysis of a company's financial performance, market opportunity, operational risks, and valuation. It goes far beyond a pitch deck or fundraising presentation. Instead, it provides the detailed information investors need to make informed investment decisions. If you want to understand how valuation reports are structured or explore professional valuation tools, you can learn more at valuationforyou.com. And if you found this video helpful, like the video and subscribe for more clear guides on business valuation.